It looks like we have a pretty good group here, so I think we can kick things off a little earlier than usual. Thank you all for coming to CoinFund Rabbithole featuring Synthetix, Kane Warwick and Justin Moses. As many of you may know, I see a few familiar faces in the crowd. CoinFund Rabbithole is a monthly, sometimes twice a month, series of events where we bring in a project or founders or people doing interesting things in the blockchain-based ecosystem to hear about interesting or innovative token economics or product design. And yeah, today we have Synthetix. So Synthetix is a decentralized synthetic asset platform that provides on-chain exposure to real-world currencies, commodities, stocks, and indices. Kane, the founder of Synthetix, previously built the largest cryptocurrency payment platform in Australia, while Justin is a former director of engineering at MongoDB and has significant experience designing and deploying high availability systems at scale. Today they will be talking about staking mechanics. And I think there's no bar in the back, but fear not. I think we can all head to the rooftop after the talk to grab some drinks and chat a bit more. So without further ado, take it away, guys.
Hey everyone, thanks for coming. So I'm just going to raise your hands if you have no idea what Synthetix is. Okay, a couple people. So I'm just going to do a quick kind of intro to the platform before we go into the staking mechanics, because they're somewhat related, but also kind of independent. So what we've built is essentially a platform that allows you to issue debt, and that debt is in the form of synthetic assets. So assets that track real world prices. So fiat currencies, we've got synthetic USD, synthetic AUD, we've got synthetic gold and silver. But more recently, we have kind of focused on synthetic cryptocurrencies. So we've got synthetic Bitcoin, synthetic Ether. We've also got inverse indices of Bitcoin, Ether, BNB, and some other currencies like Maker, etc. And so what we're trying to do with that platform is essentially allow people to trade these synthetic assets on an exchange. And the advantage in trading synthetic assets that are collateralized by a single pool of collateral, which is our SNX token, is that you don't have the same liquidity issues you have with other platforms. So decentralized exchanges have kind of been plagued by this idea of, the network effects are really hard to kind of bootstrap, right? How do you get people to come in and provide liquidity into something like 0x or IDEX or what have you? There's a few assets that will have pretty deep liquidity, but a lot of times in the long tail of assets, there's not much liquidity. And so you find that people will go to a place like Binance or BitMEX or wherever. And so what we've done is we've basically said, if you have this pool of collateral, so people will stake their tokens and issue this debt, people can move between assets, they can shift between different assets, and they don't have any liquidity restrictions. So the way that works is someone stakes their SNX token and they issue, say, SUSD. And that SUSD is priced using an oracle. So we have an oracle that says that the price of that debt is based on the US dollar. We've got a bunch of API feeds that push that price in. And then someone says, okay, I've got that debt, and now I want to reprice it. I want to reprice it into Bitcoin. And so the oracle will essentially allow them to take that debt, let's say they've got $1,000 worth of SUSD, and they can reprice it into Bitcoin. And that allows them, without a counterparty, to essentially trade different synthetic assets. So they, at no point, relinquish control of the asset. They've got it in their own wallet, and it just gets repriced. So the way that this system is supposed to work is that the repricing of these assets costs money. Right? We charge an exchange fee, and the exchange fee is paid to the people who stake the system. So when we launched this back in December of 2018, as you can imagine, there wasn't much activity, right? And so you have this problem of network effects where people are encouraged to stake based on the fees that they're getting from exchanges, but there's no one really staking because there's no exchange fees. And so we had very little activity at the beginning. And so what we did is we essentially said, okay, how can we bootstrap this network, right? How can we get people to start to stake the system? Because at that point, it was basically the team and our foundation that were the only people staking. And so it was really limited in terms of the amount of debt that we could issue and the amount of trading activity we generate. And so what we did is something that was kind of controversial, and we were a little bit worried about it at the time. But like most ERC20 tokens, we had built the system with a fixed supply, right? And I blame Fabian for this because, or technically Vitalik, I suppose you could say, but Fabian was the one who kind of implemented it. Defaults are really powerful, right? And one of the defaults in the ERC20 token is you have to specify a bunch of things. And one of them is what's the supply, right? So you say, I want 100 or 1,000 or 1,000,000 or 10 billion or whatever the latest is, trillions or something like that of tokens. But the idea was that you've got this fixed supply of tokens and therefore you'll have scarcity, right? And I think what we found is that that's kind of dumb. It doesn't actually make that much sense, right? Just having a fixed supply of something that has really no demand doesn't make it valuable. You can have one, I can get 10 pieces of paper and write my name on it and say, who wants to buy them, and hopefully none of you will. But if I was to then take away 5 of them and say now there's only 5, there's no more demand for it because it's a worthless piece of paper, right? And so we basically said, okay, we've got this fixed supply token, and we don't have anyone who's really incentivized to participate in the ecosystem, right? And so I took a step back with the team, and we really looked at what is the way that we can kind of bootstrap this. And we looked at the mechanics that you see in proof of work systems and even some proof of stake systems, and how powerful those systems are in getting people to actually engage with the network, right? So Bitcoin mining is probably the best example of this. If any of you were mining Bitcoin back in the day, you remember how painful it was. I remember spending like 2 weeks trying to get a GPU miner working. I actually don't think I was ever able to get it working. I've got like an old DAT file that's sitting there that has nothing associated with it. But it forced people to engage with Bitcoin. It forced people to understand how it worked, how mining worked, what the mechanics were, all of that stuff, because you were being paid, right? The network paid you to engage with it. And in a fixed supply ERC20 token, the network doesn't pay you to do anything. You're really incentivized to just buy it and let it sit in your wallet. And if you look at a lot of Ethereum wallets, they've just got 20, 30, 40, 50 tokens just sitting there, no one's doing anything with them. And so what we said was, okay, let's actually change the supply mechanics from a fixed supply to an inflationary supply. And instead of just having that inflationary supply go to people for some arbitrary action, we said we're only going to pay that inflationary supply to people who stake the token and who are essentially doing what we want them to do, which is to collateralize the network, right? And we also said that when we distribute those inflationary tokens, it's going to be on a pro rata basis based on your actual performance, right? So all of a sudden people had to actually learn how to use the system. They had to, they previously been sitting on tokens like most people do with tokens and saying, okay, great, when is it going to go to the moon? That was kind of the question that we would get asked all the time. And all of a sudden, when we changed the supply mechanics and said, okay, there's now going to be this inflationary supply, and it's aggressive inflationary supply, it's 75% in the first year, and then it halves every year for 4 years. We had people come out of the woodwork that hadn't touched the tokens, hadn't done anything. They're like, now this minter thing, how does that work? And so we'll actually show you. Justin's going to pull up the Minter interface and just give a bit of a demo on how the system works. Yeah. So basically, what you start off with is you've got SX tokens, right? So you've got the collateral token, and that collateral token is locked, and you issue debt against it. And the system allows you to issue up to 750%. So it's quite a high buffer, right? The network is really over collateralized, right? So if you know Maker, they allow you to issue up to 150%. Obviously, ETH being a lot more liquid, there's, although as we've seen over the last couple of days, less liquid than we might like. But there's a significant buffer required in order to make sure that the network's fully collateralized. So you lock your SNX and you issue debt in the form of SUSD. Yeah, so you can see there's SUSD that's been minted. There's about 2,400 SUSD that's been minted, and there's another $1,000 worth of SUSD that could be minted. And so we can mint the rest of that SUSD, or most of that SUSD. Sure. And we're on Coven, yeah. So it should be pretty quick, hopefully. Great. So we've essentially locked a little bit more of the SNX supply, issue SUSD, right? So what that then enables is you've got this SUSD, you've got this debt, it's backed by the SNX token, and you are now able to go to Synthetix Exchange, and you can convert that debt, again, repricing it basically via an oracle, into, say, Bitcoin. So the price right now is $10,900, so we can take that $500 in SUSD and convert it into 0.05 BTC. And so once you convert this into BTC, you can sit on that BTC if you want, and if the price goes up or down, you can convert it back into SUSD, and you can take profits, or losses, depending on the direction the BTC goes. And so what this essentially enables people to do is, on Ethereum, to trade synthetic assets, right? But again, the challenge that we had was, how do you get people to actually stake the system? Because there's risk there, right? And now with the inflationary supply model that we've gone to, we went from about 33% of the network being staked. If you can pull the dashboard back up. So yeah, it was about 33% of the network being staked, of which 95% was the foundation and team and people who were kind of pretty close to the project. And now it's up to 73% of the network staked. And again, the reason why people are staking is because that high inflation means that if you're not staking, you're being inflated out. But what's been really interesting is that we've gone from having about 30 or 40 different wallets that were actually actively minting and participating in the platform to almost 1,000 now. And so it's been really powerful. And I think the lesson, or at least the takeaway for us, has been that we spent probably 6 months kind of talking to people, trying to work out, should we make this change, right? We came out and we did a token sale, and we said, there's only 100 million tokens, it's never going to change. This is it. They're scarce and valuable and all of that stuff that everyone says about fixed supply tokens, but it wasn't working. The actual mechanism wasn't working. People weren't engaging with the network, and so when we changed the monetary policy, theoretically you'd expect that the token would be less valuable, right? There's more tokens out there. You've inflated the supply. But the reality is that higher engagement actually meant that the token went from, when we launched inflationary supply, I think it was sitting about 4 cents, to now about 25 cents. So the actual value of the network and the engagement of the network went up, almost tenfold, because people were actually using it. And once they started using it, they realized this is actually a really cool platform. I want to actually trade on it. And now what we've seen is that the trading volume, if you can go down a little bit further, not that far, sorry. So we're doing somewhere between $500,000 and $1 million a day in trading volume. And again, this is a DEX, right? So that's pretty high for a DEX. Think Uniswap, Kyber, they see like 1 million to 2 million a day. And the total volume that we've done is about 66 million. So again, the engagement has gone up incredibly since we've basically changed the mechanics of the token. So the final thing that I'll talk about is something that we. Sorry, just scroll up a little bit more. So something we've been trying to solve though, right? Because technically this is a stablecoin project, so it's also an exchange, it's a synthetic asset platform, but we've got this asset up there, which is SUSD, and SUSD is supposed to be $1, and it's not $1, it's 92 cents, right? And the problem that we had when we had this big run up in value of the network was that people had a lot more value in SNX tokens, so they could issue more debt, and that debt flooded the market, right? Which was a similar issue to what DAI had when there was an overabundance of supply and not enough demand for people to buy it. And so we've been trying to work out, how can we rebalance this network, right? How can we build incentives to actually get more liquidity into the SUSD supply, and also to incentivize people to buy it up if it's off the peg, right? And so something that we've done recently, like as recently as this week, is we've started to incentivize people to put liquidity into a Uniswap pool. So we basically said, if you deposit synthetic ETH into the Uniswap pool with Ether, we will pay you, and this is a trial at the moment, we're running it for 4 weeks, but we'll pay you part of the inflationary supply because we've got this supply, we can incentivize people to do certain actions. We'll pay you about 5% of that inflationary supply directly to liquidity pool token holders. So if you're holding liquidity pool tokens in this pool, you'll get paid SNX. And what we've seen is that, I'm not sure if you can see the total pool size, but it's gone up to almost 1,000 ETH in the last like 4 days. So, you know, this is a really powerful mechanism that you have if you have got an inflationary supply, right? You can actually direct that inflationary supply towards specific incentives and behaviors that you want within the network, and you can get people to do stuff. And in this case, again, this was like 4 days ago, we said, you know, we're going to start incentivizing it, and you know, we've already got 1,000 ETH in there. So, you know, potentially we might end up with 2,000 or 3,000 ETH in this pool. Now, that obviously doesn't solve the problem of the peg, because now we've just got a lot of liquidity that's off the peg, but you know, it's definitely an improvement. So what we're also going to look at doing is potentially allowing people, by building a contract that essentially says, if you buy ETH, or sorry, if you buy synthetic ETH through this pool below par, you will be able to then convert it directly into SNX, which will give people essentially an arbitrage cycle that they can use. And we've also got a very deep liquidity pool in Uniswap for SNX. There's about, I think, 1,400 ETH in that liquidity pool as well. So essentially we're saying that we will provide tokens, provide SNX tokens for you to buy if you buy below par through this pool to arb the peg and to bring it back up, and then you can sell that SNX or hold it or do whatever you want. And so again, you know, this is all very kind of empirical. We're looking at the dynamics and, you know, the behaviors of people within the ecosystem and trying to kind of adjust the incentive model to ensure that people do the thing that we want and don't do the bad stuff that we don't want, right? And that's, you know, again, the approach that we've kind of taken is this very iterative approach, looking at, you know, what are the behaviors we're seeing, what are we observing, and then trying to essentially, you know, create, I guess, you know, different incentives to get them to adjust that behavior. And the reason why we've got, you know, I suppose the ability to do that is because of this inflationary supply. So I think that it's something that, you know, a lot of token models really need to consider. You know, that this idea of a fixed supply and this artificial scarcity that we've all been kind of, you know, telling ourselves is so valuable and important, actually is a lot less valuable and a lot less powerful than if you have the ability to kind of direct, you know, inflation and you know, create a model that will push people to do what you want. So yeah, that's pretty much it. That's what we got. So yeah, questions? Yeah.
Can I go back to your SUSD? So the 92 cents is getting its price not from an oracle, from...
Yeah, that's the on-market price. Yeah, that's the exchange rate at the moment.
On your platform?
On other exchanges. So we're on like KuCoin, Bittrex, Uniswap. So the Uniswap pool is sitting at about 91 cents.
So does the oracle only get called when you do this, when you want to go into another asset class?
Yeah, correct. So within the exchange, a dollar is treated as a dollar, but off exchange, you know, we want. So essentially, as you can imagine, if someone comes into the exchange, it's like they're depositing into like a centralized exchange, right? And once they're in there, then they can trade within that exchange. When they go out, though, they need, again, liquidity, and they ideally want that, you know, the peg is stable so that they don't lose money on the way out, on the exit.
Right, but the oracle gets called when I want to go from like synthetic USD to synthetic USD.
Correct. Yeah, that's right.
Do you pay an interest rate when you make synthetic USD like Maker?
No, we don't. So the way that the SNX token drives its value is from those exchange fees, right? So if you're holding SNX and you've staked it, as people exchange, it's a little bit like Uniswap liquidity tokens, right? You put value into a liquidity pool, and then you get the 30 basis points fee paid to your, you know, paid to liquidity token holders, right? So for SNX, you stake SNX, and then if you just pull up, if you can go back to the dashboard. So.
I'm so sorry, I'm sorry.
Oh, sorry. Yeah, that's fine. Yeah, I can pull it up a minute.
And do you have a price feed, like a centralized price feed for SNX? Like, why can't I just redeem $1 worth of SNX with SUSD?
So this is the thing, right? You know, we've basically had to create this model. There's no pool of SNX for you to redeem directly into,
okay.
right? So because individual people are minting, you would need to be able to, as an SUSD holder, send it directly, like a CDP holder, right? You as the CDP holder can pay it off, and technically someone else can pay it off for you as well. But in Synthetix, someone can't just send SUSD and get SNX back, which is why we're using Uniswap as kind of like a backdoor mechanism to allow arbitrage.
But the way Maker works, like the reason that it's $1 is that it's a two-sided market. But like there's an interest rate between DAI holders and CDP holders. So like in Maker V2, right, there'll be a
Sure, of course, there's savings,
so
right?
like that's how you get back to the peg, is you have an interest rate on SUSD.
Potentially, I'm a little bit of a DSR skeptic. I'm not sure if it's going to be sufficient to fix the peg, but we'll see. I mean, it's a question of, I guess, when you have a soft peg like in Maker and Synthetix, you need a strong arbitrage cycle, and so that's why we're exploring the Uniswap pool and essentially allowing people to buy SNX directly for SUSD via the pool.
I don't think DAI is currently pegged.
No, it's not. No, but it's closer than 92 cents. So they're doing something better than we are. Yeah, I mean, as I said, like it is very challenging with a soft peg. If it's not directly redeemable, it can be pretty challenging. So.
Yeah, can you just give us a quick post-mortem of the Oracle issue you had?
Yeah, for sure, yeah. So we had an issue about 2 weeks ago where we have a centralized Oracle. That Oracle has about 40 different price feeds for different assets that come in. And we've got multiple feeds, so multiple different APIs for different things. And essentially we had bots that were front-running our Oracle. They had different strategies, different approaches, but there were quite a few bots in the system that were essentially trying to observe the price feed, and whenever there was a significant shift in the price feed, they'd try and get in before it, and then take essentially risk-free profits. It wasn't perfect, but they were fairly profitable. And while this was all happening, before we'd been able to implement front-running protection, which we now have, there was an issue with the KRW feed, so the Korean won, where one of the APIs went down, and then simultaneously another API decided to publish a price that was 1,000 times higher than it should have been. And so, as you can imagine, that bot was like, great, profits. It went in and converted, I think it had about 30 grand at the time when it started. And so it went from 30 grand to like 30 million, and then you just cycled up all the way up to I think 11 billion it got to.
The price kept, for some obscure
It was-
reason, the price kept alternating too.
So it didn't just go once and say like, okay, the Korean one's now like 85 cents instead of being 00085. It actually went to 85 cents and then went, oh, oops, and went back, and then went to 85 cents again like 3 or 4 times, and every time the bot was like, great, free profits, and went back and forth. So we got to a point where I think it had something like $11 billion or $8 billion worth of debt in the system. Now, as you can imagine, there's $30 million in collateral and $11 billion in debt. The system's essentially under collateralized. So that person was unable to kind of cash that out, as you can imagine, right? It would be the same thing if Maker CDPs had however much it is, I think like $150 million worth of value, and something went wrong with the feed, and there was suddenly $50 billion worth of DAI, right? Like there's not enough ETH to support it, so you wouldn't be able to cash it out. So we essentially talked to the person and said, okay, we want to roll back this trade. We rolled back the trade with them, and then we've now subsequently implemented some pretty aggressive front-running protection to stop that from happening.
Are you planning on making those feeds decentralized, and what are the most likely kind of technologies that you use to do that?
Yeah, so funnily enough, one really cool way to find out everyone who's working on oracles is to have an oracle problem, and they kind of come out of the woodwork. And so we had about 10 different teams reach out to us over the course of like that week. Some that day, and we were like, okay, thanks, just give us a couple of hours to figure this out first, and then we'll have a chat to you. But we've been talking to Chainlink. We've been talking to the team from UMA. We've been talking to a number of different people. And there's a whole bunch of different approaches to this problem, right? At the moment, what we're really looking for is something that will make not necessarily the Oracle more robust or decentralized, but to take some of the risk out of a single point of failure, right? And so I don't know that there's necessarily like a perfect solution out there, but certainly there's better solutions than what we have right now. And so, at the moment it's a bit of R&D, but we've done a bit of work with Chainlink, and we're pretty confident that it's certainly an improvement on our current system.
So is that a way of saying, like, it doesn't have to be a fully decentralized Oracle, but if you can distribute the job of
100%.
to many people, it makes it like more decentralized?
Exactly right. Yeah. Like at the moment, it's a bunch of APIs that we control. Right now, assuming that we're not malicious, then okay, that's great, but we might just do something wrong, right? And the API might go down. I mean, it's an interesting question as well, because for the Forex feeds, for example, there's obviously commercial APIs which we use, right? There's a very solid chance that the people who are running nodes in Chainlink could have been using those same commercial APIs, right? So that same problem, assuming that there wasn't strong redundancy in the data feeds, could have potentially propagated through the system. So, it doesn't necessarily solve it, and you get to a point where if there's enough value that's secured on chain by these oracles, then there's a lot of incentive to kind of attack them, right? And we've seen some of the commercial APIs are not very robust. So it's not necessarily something that I think is easily solvable. There's layers of incentives that need to be created.
Are there any legal issues around, or what are the legal issues around trading on Synthetix?
Yeah, so it's kind of an interesting thing, because we don't have a marketplace, right? So we're not matching orders. So you're not trading with me. You've got debt that you've either issued or you've purchased from someone outside the system, and you're essentially repricing it, right? So whenever a trade happens, it's actually not between two parties. It's literally in your wallet. The funds never leave your wallet. So you've got, say, debt priced in ETH, and you want to reprice it into Bitcoin, you can reprice it into Bitcoin. And obviously it's a gray area in terms of how that would be regulated, or if it is regulated, but
Yeah, I guess concerned a little bit less with ETH and Bitcoin than synthetic Apple, for example.
yeah, well, we don't yet have Synthetic Apple on there, so we're still doing a sort of final legal review of the implications of that. But it's something that we definitely intend to do. And as it stands now, our lawyers, we're based in Australia as well, so our lawyers in Australia are pretty comfortable that we should be okay to launch that, but we haven't launched it yet. So,
Are there precedents for synthetic, say like equities that have been attempted?
I don't think there's precedence in this way, because most synthetic assets are traded against counterparties, right? There's a marketplace where people are trading against each other. So something like this, where it's literally an oracle that's allowing you to reprice it, that's why I say it's kind of gray. If you and I were trading synthetic assets and we were providing a venue for you to do that, that would definitely be across a pretty clear line. But we're on the other side of that line at the moment. So
There's obviously many use cases for synthetic USD, synthetic Bitcoin, etc. But what would you say is kind of the primary, let's say, target market in your mind for these assets?
yeah, it's a really good question. So we started out as a stablecoin project, right? The project was called Haven, and it was a single decentralized stablecoin that was kind of modeled off a closed loop payment network. And what we found is that as the market matured and as regulated stablecoins became a thing, it was really hard to kind of scale a decentralized stablecoin. We've got, as someone pointed out, issues with pegs are much harder when you don't have direct redemption into a fiat currency that's sitting in a bank. And so Maker and us have obviously struggled with that. And so what we found is that the kind of immediate use case in most crypto platforms is for trading, speculation, right? And so when we launched synthetic gold and then subsequently synthetic Bitcoin and ETH and other crypto assets, the trading volume and interest went up significantly. And so I think in the short term, it's going to be launching assets that say a BitMEX or a Deribit can't support because of liquidity issues, that we can potentially support because it is a purely synthetic asset. So I think in the short term, it's going to be trading, basically.
Okay, so can I have a quick follow-up?
Of course, yeah.
So it might be the case that when, most DEXs are on Ethereum today, so you just have ERC20 and Ether. Do you find that the synthetic assets that are not Ethereum, are they driving kind of more interest in your platform than other assets?
We haven't seen that yet, but we definitely have a thesis that will be the the case. So one of the first things we launched was BNB. So the things that have migrated off Ethereum, so Tezos, BNB, Tron, etc. We think that there could be some demand for trading those, particularly for inverse assets as well. So.
Do you need to register an account to use the platform?
No.
A little bit ago, you used the term rollback. I'm talking about your Oracle.
Yeah.
What's the level of sort of benevolent dictatorship that you have now and in the future?
Yeah, it's pretty high.
Where's the minimum?
It's pretty high at the moment.
Yeah.
So that person actually participated with us. So basically what happened was we changed in the Oracle, we reset the rate of KRW, and that person did an exchange from their own wallet into another wallet to basically roll
Okay,
it
so
back.
it wasn't a rollback.
It wasn't
in the blockchain sense.
Yeah, not in the, exactly. Sorry, not in the blockchain sense. It was more like
He
participatory.
traded against
He traded
his
against
things.
himself, knowing that he was going to lose. Right. We paid a bounty for him to do that. And it was kind of a hostage negotiation at the time of how much he wanted, etc. But we were able to come to terms, and he was happy to kind of roll it back. But we do the architecture of the system uses proxy contracts, so we have a lot of power over the system. And I guess kind of ideologically, while we are the intention is to move to a fully decentralized system, ideally run by a DAO where all of the configurations and variables are controlled by some kind of mechanism where token holders can participate and contribute to that. At the moment, it's fairly centralized, but there's definitely an intent to kind of move away from that over time.
So this was a great presentation, and I loved kind of the focus on the power of incentives. But I wonder if there's any trade-off you see to a protocol or application kind of actively changing its token economics over time. Like, for instance, if I'm a staker and I come to expect just having to change my approach to getting the right amount of getting the max inflation over time, that might be a disincentive if it becomes kind of like overly complicated. So I wonder how you think about that trade-off, and if you kind of are only thinking of experimenting for a few more months and then kind of keeping the same incentives for the foreseeable future. How do you think about that?
Yeah, I think you need to get stability at some point, right? Like people need to have confidence that the system will be crystallized into some final form. I just think that, like any kind of complex system, assuming that you're going to get it right the first time or even close to right is just like laughable, right? So this idea of like we're going to release contracts and they're going to be final and we won't be able to change them is just really not viable. So that said, it is a problem and people are somewhat resistant, but I think we've tried to engage our community. So we've got a system similar to EIPs called SIPs where, if we're going to make a change to the system, we propose it to the community votes, we have governance calls, and they're pretty actively engaged, right? We've got almost 80% of the network is staking. They sometimes disagree with each other, and there's a bit of contentiousness there. But most of the time, we can kind of arrive at some reasonable decision. So one of the things we changed recently was when we launched the C ratio, the collateralization ratio, was 500%, and because of this oversupply, we said we want to raise it. Personally, I thought 1,000 was good. Some people wanted 600. We talked about it for 2 or 3 weeks and eventually came to the conclusion that 750 would be good, which has worked fairly well. I think we may need to raise it a little bit higher, but it's improved it. So we've seen that that's a lever that works, right? But that was, again, a kind of collaborative discussion with the whole community trying to engage people. So.
If 100% of the supply of SNX is staked, what's kind of the annual inflation rate?
Yeah, so it's 75%. 75%. And it's a good question. It raises a kind of issue that we do have at the moment. Because the staking rate is so high, the float on exchanges is quite low. It's about 3% of the network, maybe a little bit higher if you throw in Uniswap, about 4%. And so there is a question that people raise of you're using this collateral, which is fairly liquid, and there's a low float. Uniswap helps with this massively, and I think if you're running a project or you're involved in a project, having a deep liquidity pool in Uniswap is like so critical. It's amazing how much of a dampener it is for large moves. Price action, it really kind of ties it down. But the argument, I guess, that we make for why having this token as a collateral token is viable in the long term is that there is a kind of valuation methodology you can apply, right? There's cash flow that you can get by staking directly from the exchange fees, right? So, I think we said there's been something like $400,000 worth of fees generated. So if you're a participant in the network and you have 1% of the network staked, you can kind of work out, okay, this is what my yield is, and based on that yield, you can decide if that yield is high enough for the risk that you're taking, or too low, or whatever, and the market will find some kind of equilibrium for that asset, essentially. So as opposed to ETH, which is kind of this free-floating asset where it's kind of hard to price it. The market moves around fairly aggressively sometimes.